So let's continue with accounting for receivables. Well, technically speaking, we've already covered accounting for receivables partially in previous weeks, in previous exercises and courses. And now we're just going to deepen our knowledge of accounting for receivables. Now, what we know so far is that revenue recognition principle is what we use normally, following the accrual accounting principle. And here, revenue recognition principle tells us that, let me just have my pen ready. So revenue recognition principle says that companies must recognize revenue in the period in which it was earned and not when the cash was, received. So even though you have received your cash, let's say you haven't received your cash yet, if you have earned your revenue, you must recognize it. Now, companies recognize the revenue using this four-step process, and here it is. This is probably the new information. So there is this four sort of step process that allows us or helps us to identify whether we should recognize or not recognize the revenue. So here we go. The very first one is that we have to have some kind of credible evidence that the arrangement between two parties exists. So when we're talking about two parties, we mean the seller and the buyer, or the service provider and the one who uses the service. So these are the two parties, and the arrangement exists. The arrangement could exist in the form of, for example, we signed a contract. So if we sign a contract, that arrangement exists. There is a credible evidence of that arrangement. Then we have the invoice, when we have maybe purchase order and so on. So there's some kind of document that proves the serves as a proof of the arrangement in the place. The second one is that goods or services have either been delivered or provided. The service has been provided. The third one, the selling price is known. The fee is basically known. We have to know how much that costs. And the third one, there is a reasonable assurance. So we're sort of assured that the amount that is owned will be sort of received, it will be delivered, the seller knows that it will be collectible. So these are basically those most important steps that we use as a benchmark to recognize our revenues. Now, here we have this example, and again, this is basically repetition related to revenue recognition. We've covered in previous videos, so you can always go back and check it again. But just to review, landscaping company signs a $600 contract with a customer, and the period is for the next 6 months. The customer sets up sets up an in-house credit line with the company, and he agrees to pay in full at the end of the 6 months. So at the date, let's say if the contract has been signed on January 1, there is no entry here, because we didn't exchange any cash, we didn't provide any service, right? So we only signed the contract. Now, the payment is not going to be done. It will be done at the end of the 6 months period that we're talking about. The next thing we know is that we will align that with the revenue recognition principle, and we will record $100 each month as earned. We're not going to record it just because, $100, but we assume that we earn those $100 each month. So the contract was signed on January 1. So if we think about it, and we look at the there's no January 33. On January 31, we can make our first entry and recognize our revenue. So again, don't forget, the cash is not being received yet. This is only the end of the first month, not the end of the 6 months. So we're going to receive what? We're going to record what? So it's going to be a recognition of account receivable. And we're going to record 100, and the sales. I suppose this is sales, right? No, this is service revenue. Service revenue is going to be recognized as 100. Similar entries to this one we will do on sort of February 28, maybe March 31, and then April 30, and lastly we'll do it, well, not lastly, but May 31, 1, 2, 3, 4, 5, and the last one will be June 30. Yeah, so on these days we will make similar entries to this. So account receivable, I just realized, okay, account receivable 100 and service revenue 100. And by the end of this June 30, our T account for example, account receivable will look like, yeah, the balance of it will look, again, this is not all of it, but the balance of it would look like $600 will be the total balance by the end of the June 30. And the same goes for the sales service revenue. Yeah, service revenue. Revenue will have the balance on credit side $600. This is basically it. And if we assume that the payment is done on, like we said, not assume, but like here it says that the payment will be done at the end of the 6 months period, which is June 30. So the entry will be cash. Yeah, if we're doing it from this perspective of the landscaping company, it's going to be cash in $600, and the account receivable here will be closed down through the credit side, and the balance will be zero. Yeah, so this is basically how we do it, and you already know it. Now the matching principle, again, is very simple. We basically match all of those. If we go back here, we will match all of the expenses associated with making these $100, yeah, until January 31, we will sort of match the expenses associated with making this service possible and record them in that same period. Yeah, so in January we're going to record certain expense. In February, associated again with the next 100, we're going to record those in those months. Okay, so again, very briefly, you already know accounts receivables are the outstanding amount that is owed from the customer. The account receivable is a type of a asset account. Yeah, this is an asset account. It is paid in less than a year. It's not a long-term sort of asset. It's a short-term asset, so paid within a year. And there is no interest payment. So these are the three most important things that you should remember about accounts receivable. Now let's look at the specific example of the accounts receivable with a very simple one. So this one's you're already familiar with. I just want to recover the basics. Yeah. So this company, this specific company, sells various watercraft vehicles. They extended a credit line to a customer purchasing vehicles in bulk. The customer bought 10 jet skis on credit, and the sales price is 100,000, but the cost of it is 70,000. Now the record is very simple. The record of the journalization of the entries is very simple. So on the day of the sale, we're going to record accounts receivable. So we didn't get the cash yet, so we record the account receivable as 100,000 debit and sales revenue as 100,000 on credit. And if we again assume that this is a perpetual method that we're using, then cost of goods sold immediately also recognized. Don't forget, this is a 70,000, and merchandise inventory. You have now less, so that's credit, entry to the credit side. And if the customer, or when the customer makes the payment, the entries will be cash, debit, and accounts receivable will be closed through the credit side. Okay, again, I'm fighting with my pencil here. Okay. I hope that's clear so far. Now, let's look at a bit more, to the similar exercise, or to the similar example with just some kind of, zing to it. So the zing here is specifically related to the fact that the payment is done using the Visa credit card. Exactly the same type of example. There's a purchase of canoe. In this case, it's a canoe for $300, and the customer used Visa credit card. The cost to this canoe, the original cost is $150. Now Visa charges, again, don't forget the Visa credit card was used. The Visa charges, this company, Billy's Watercraft Warehouse, it charges it 5% of the sales price. So what happens here specifically is that when the company uses, we have the possibility to use, as a customer, we have a possibility to use our Visa card. In that case, the company, in this case, again, don't forget, Billy's Watercraft Warehouse, is going to record the accounts receivable, not the full $300, but $300 minus that 5%. that 5% that we're talking about. Yeah, so that's 285. Now the remaining 15% or those 5% will be recorded to the credit card expense because Visa is going to charge this Billy's Watercraft warehouse 5% for using the Visa card. Now the sales revenue on the other hand will be $300 as it is. Yeah, because the sales revenue is 300, that's for a fact, except the $15 part of it is going to be paid. It's a commission fee that we pay to where it is, yeah, so Visa company. So Visa company charges us, by us I mean the company, the retail company or service company, this fee for using Visa card services. And the cost of, I hope that's clear, and the account receivable is going to be recorded as 285. So you're going to see why it is like that. Well, not why, but how exactly it suddenly $300 of sale turned into 285. Yeah, so as a customer, yes, I'm going to pay 300. But as a retailer who receives this 300, using out of this 300 minus 15, 15 is going to be paid to Visa card company. Yeah, Visa card company. That's why in my I mean Billy's Watercraft House, we're going to record into the account receivable 285. Yeah, so 285 is going to record it there. Now, cost of goods sold and merchandise inventory is recorded as normal. Yeah, so there's nothing changed here as the cost it is. And now when it comes to the payment, yes, this is a continuation. We're continuing with the same example. Let's say that when the Visa finally pays the amount owed to the BWW, then it's going to be recorded as cash. Yeah, debit 285 and accounts receivable will be covered as 285. Now here the most important part is that you do understand how transaction between customer, yeah, so transaction between customer who uses the Visa card and then the payment is made to the retailer company, in this case BWW. Yeah, so the customer uses the credit card, pays to Visa 300. The charge Visa charges 5% to BWW and takes it out from this 300 and pays to BWW 285. And that's why BWW, knowing the percentage, the fee that has to be charged, records its account receivable immediately 285 and not 300. I hope that explains this whole situation. Okay. Now let's look at the bad debt expense and allowance. So this part is the most important part that I want to emphasize, and we're going to focus on this one. So we're talking about bad debt. Every retailer has to, not has to, but can experience certain customers who will not pay back their debts. Yeah, so we're calling them uncollectible amounts. This bad debt has a negative effect on the accounts receivable. Yeah, clearly your bad debt can be only the one that is not made on cash, right? So we're talking about the on-account transactions. So account receivables will be affected by bad debts negative way. Now there are two methods to recognize the bad debt that any company, any retail or even service company might experience from the customers. So there's a direct write-off method, which basically means that you don't make any assumptions on how many of my customers or how many or how much from my total sales, for example, I might not receive. And I just wait for the specific customer to sort of identify himself as a uncollectible, and we will, at the moment when we identify that specific case, we will write it off. Yes, but the allowance method, we make certain estimations. We estimate the bad debt during the period, that during this period some kind of percentage of my sales, total sales, might not come back to me. So credit sales, right? Not cash sales. Credit sales might not come back and not be paid by my customers. So I make first an estimation in the allowance method. Yeah, this one first makes the estimation, whereas and then writes off. If it incurs, then we will first estimate. Yeah, first step is estimate. And the second step in the allowance method would be to write off. Whereas in the direct write-off method, there is just one step, and that's you just write it off. That's it. That's it. There's nothing else. Now let's look at the specific examples. First, let's look at the direct write-off method. A customer takes out a $15 car loan, yeah, $15 car loan. So forget about the specific example. So just not to confuse you too much. Let's just go with not car loan, but let's say you bought a car. Yeah, so you buy a car. Let's go with the purchase of a car, not loaning it. And let's say that the car dealership allows to pay not right away, but before December 1. So anytime before December 1, make the payment back. So again, let's forget about this part. I'll just make it as simple as possible. Forget about the interest payment and so on. Now, in this case, we don't make any estimation. We don't have any estimation. Yeah, so we immediately look at the date. Yeah, so we on the December 1st, we go like, okay, so there was no payment made by this specific customer, and the payment, the account has defaulted. Yeah, because of no payment. So what we will do in that case, this account receivable cannot just stay there, right? So we have to credit it. So let's say that the sale has been done. The sale was account receivable. Account receivable will be debited 15,000, and the sales, for example, is credited. 15,000. 15,000. And now when we realize that this 15,000 is never coming back, probably by December 1, nothing came back to me. So I need to, expense it. And I do credit side here, one credit side here, and my debit side is going to be to a bad debt expense account, and that will be debited to this account, 15,000. So that's how and this whole entry is, write off. We write off that bad debt immediately. But it is also possible that, okay, so until December 1, no payment was made, but then customer who probably experienced some kind of financial difficulties has managed to pull himself back onto his feet by next year's May 1st. Yeah, so the customer makes the full payment. But because you've already reversed the entry, you've annulled the entry in this one. Yeah, if we go back, you see that you closed this account, but now you need to bring it back. You realize that, okay, we closed it because we assumed that there is not, he didn't pay by the deadline, which was December 1. This was the final day, and he didn't pay. So we assumed that there's not going to be any more payments, and that's why we closed it. And there's a zero balance in account receivable. But now that he's paid us back, we need to reverse it. So in the December, just not to go back and forth between the entries, between the slides, I'll just copy it here. So what we did in December 1, when the payment wasn't made, we wrote bad debt expense debit, 15,000, and we credited account receivable to write off our bad debt, to write off that bad debt that we've experienced. And now we're just reversing it. We bring back our account receivable through the debit side, and we close the bad debt because it's no longer bad debt. Again, my pencil. Okay, so it's no longer bad debt. So we need to get, to zero out so it's going to look like this, bad debt expense account looks at first in the December 15 we entered to the debit side, and now we credit it. So this is this side. So we entered this, and now bad debt is now 0, and we receive on the same day the cash from the customer, and account receivable finally is closed again, not because of the bad debt, but because the cash has been received. I hope that's clear. And okay, so now that I've explained the direct write-off, so I hope you understand by this point what the direct write-off method looks like. Let's just review how the allowance method looks like. So the allowance method, there are 2 steps. First, the estimate, and the second step is to write off. So and as you can see in the early one, in the direct write-off, there was no estimation. We just write it off immediately. Now, the estimation, the allowance method here first tells us to make an estimation. So when you do an estimation, you first write the bad debt expense, you increase it by the estimated amount. I don't know, that could be any sort of, so depending on the company, depending on the accountant's experience, he might sort of make an estimation, like let's say that out of the total credit sale, sale amount, let's say 3% will be insolvent, so that 3% will be recorded into the debit of the bad debt expense. And allowance for doubtful accounts, this is a new account that you are seeing now. This is a contra asset. Oh, it's actually written here. So it's a contra asset account. So you will basically credit it. So it increases through credit side, although it's an asset account. Yeah. In the balance sheet, so let me just show it to you here. Let's again assume that this is a balance sheet. Balance sheet. It has the same logic as accumulated depreciation. So you have an asset section. Asset section, you have cash. I don't know, account receivable. Yeah, let's just simplify it. And if you have an allowance for doubtful accounts, I'll just write it simply here. And let's say your account receivable says that you have 10,000 in total, but you estimate possibly, let's say 300 of it will not be paid back. So because this is a contra asset account, it will be a negative number. Negative. You will record it under the assets. Don't forget, you record it under the assets, you put it into the brackets to show that it's a negative number. And let's say cash is also 10,000, but you have it. So your total assets, if there's nothing else, let's assume there's nothing else, total assets will be 20, and so we have 19,700 will be your total assets. Again, it doesn't mean that 300 hasn't been collected. It means that we'll make we only make an estimation, and this is related to our conservatism principle that we've studied in the conceptual framework. The conservatism principle always says that you always have to underestimate your assets, and this is exactly what we're doing. We're applying that conservatism principle. We make the roughest estimation possible that this amount is not going to be collected, so we will just use it and make sure that this amount, so 10,000, account receivable 10,000 minus 300 is going to be 9,000. Yeah, if we remove, don't take into account this cash side or whatever. Yeah, so this 9,700 is going to be NRV, which is net realizable value. Yeah, NRV. So we assume that hopefully we will get all 10,000, but we will make an estimation that 300 possibly will not. There's a highly possible chance, not highly likely, but let's say we make this allowance that, okay, possibly based on the past experiences, $300 will not be collected. So the net realizable value is 9,700 that we almost 100% sure that we will receive. Yeah, that's it. So what we have here is if accounts receivable is 90,000 and allowance of a doubtful account is 4,800, your net realizable value will be 85,200. Yeah, net realizable value of specifically receivable account, because net realizable value in different contexts will start appearing here and there, but in this context we're talking about account receivable. Yeah, NRV of account receivable is 85,200 on the balance sheet. Okay. So I hope that's quite clear, but let's look at an example. Yeah. When there's I don't have an example, but okay. Yeah, when a specific customer has been identified though, so first we make this estimation. We make this estimation. We record bad debt expense debit and allowance for doubtful accounts credit. And then when that, again, if we assume that there's a estimation was 300 and one specific customer, we identified it, customer, no more estimations, it factually happened, so now it's a fact. That one customer did not pay, let's say $20. Yeah, so in that case, allowance for doubtful accounts will go down through debit side $20, and account receivable on the other hand will go down $20 through the credit side. Yeah, so again, don't forget, this is contra asset account, and this is just asset account. Okay. It's also possible that, like in the previous example with a direct write-off, the customer suddenly unexpectedly pays back what he owes. In that case, again, we reverse the entries. Yeah, so we write now again back this $20 will be debited again to the account receivable, and account allowance for doubtful accounts will be debited to credited to them this account, and we will receive our cash of $20, and account receivable will again be reduced to by $20 in the credit side. Yeah, I hope this is very sort of it helps you to understand this topic much better. Just try to review it as much as possible, and next we will do some exercises.